Welcome everyone to Kickstart webinar number 4, References. It's April 5th, Wednesday, 2017, high noon Eastern Time. We'll go for about an hour. Jim and I want to thank you all for taking time out to be here. I like doing these slides. I think this is going to be very helpful to a lot of you. So we appreciate you being here. Of course, we're recording it and it will be at the training site, training.jdaltontrading.com. Also, we have placed the slides in the handout section. If your browser doesn't work too well with the GoToWebinar interface, no worry. Please go to training.jdaltontrading.com, webinars, upcoming Kickstart webinars, and you'll see a button there where you can access the slides. So with that, I hope you all enjoy the presentation. I'm looking forward to it myself, and I'll turn it over to Mr. Jim. Hey, Jim.
Hi, good morning. Thank you. I'm not going to start with the slides. We'll come to the slides. But what we're really talking about, we're talking about using references in order to view and make sense of the market. It's kind of a, when you do it on the slides and, you go through it in a linear manner, there's some value to it, but it's not the same as immersion. Today was a wild morning from a trading standpoint, and I want to walk through the difficulty I'm sure many people would have trading a day like today. On this easy side, we have the inside day yesterday, which was the third inside day in 6. So what that tells us, it tells us that this is a market that really hasn't any long-term view right in here. We're not seeing anything taking place by the longer-term sellers. We're not seeing anything taking place by the longer-term buyers. We're in a trading environment. One Monday it's down, the next Monday it's down, the following days it's up. Then you gap higher today. What's been going on, and this makes it very difficult to comprehend markets and to learn to trade. Today, and for the last couple of days, this market has been supported by crude oil. Crude oil is currently up 18 cents. But look at the bar on the, let me make that bar just a little bigger. You can see how much higher crude was today. At 10:30 Eastern Time, one of the reports for crude oil inventory came out. Prior to that, the market had been up at 51.88, approaching the $52 level. Just prior to the report coming out, the market started to fade off. The report came out and the market actually went down to negative. Now it's come back where it's up 23 cents. You will find that had a lot to do with the trading of the E-mini. The market gapped higher this morning. As it gapped higher, crude was very strong. Additionally, you had a ADP employment report that came out substantially better than expected. But this market, in my opinion, is keying mostly off of crude oil. That makes it a very dangerous market to trade. Looked to me like the buy, there was a buy when the market opened, gapped higher, there was no give back. So from a mechanical point of view, as a short-term trader, there was no give back whatsoever when the market opened. And then the market was off for a couple of periods to the upside. the volume, when I went over and checked the volume, oops, the first thing that caught my eye was for a big move up like that. The first half-hour volume was 386. Now, you've probably heard, if you've been around us for a while, that I consider about the minimum volume for the first half hour to be about 380. And there's no magic in that. It's just something I've seen from observation. And if that's all the volume that I'm getting in that first half hour, and the market goes up, more than likely I'm getting trading money, but I'm not getting a healthier combination of trading money and new longer term or stickier hands buyers. So once I see that in the morning, that puts me on guard. And it tells me this market may trade higher for a while, but don't get over enthusiastic. Don't get pulled into the trap. Now somebody said, well, but Jim, it went higher all day long. That's all right. That happens sometimes. But when you're trying to assess the risk, trying to assess how much risk do I have if I go long in here? And that's the kind of thing I want to know. When I see that kind of volume early in the morning on a big gap higher, I'm not very enthusiastic about being on the long side. Now let's go back to the market. At the same time, I'm going over and I'm looking at crude oil. So I'm understanding what is going on. I'm understanding that what I'm looking at are emotional traders, short-term, day and short-term traders, emotionally buying because crude oil is going higher. Again, if the volume wasn't there, didn't suggest to me that I had any really substantive underneath support for this market. So a lot of what we're talking about, particularly in the Kickstart program, is how to view markets. And I understand if you're relatively new, this can be very, very frustrating. You would like to have things that made more sense to you. They were more linear in nature, and there was more exactness to them, so you had some idea what to do. Unfortunately, it doesn't happen that way. Like I said, I did see a trade early in the morning, this is before, I knew crude was up, but this is before I had any volume numbers or whatsoever. There was no give back on following the gap higher. That is a buy. You've got a gap, no give back at all, go with that trade. No matter what kind of trade you do, you need to know how to monitor for continuation. So you're gapped higher. The next thing you're going to look at is going to be the two-day high from the 30th and 31st. And as you know, we've talked about that for some period of time. There was no excess at those 2 days. That is just a piece of information you carry forward. Even though there was no excess, the market, did drop down to the 2340 level. Sometimes something like this occurs because the market got too long in the very short-term time frame. So if only all I'm seeing is short-term traders in this market, it's very likely that they just got themselves too long, and every time the market would go up here a little bit, those that are long are nervous and they're selling. This goes back to a lot of times what we say is Sometimes a market has to break before it can rally. And what's that really saying? It is saying that you've got so many, in this case, weak longs in the market. You have to flush them out, replace them with new, hopefully stronger buyers. The thing to understand is when it gets into this condition, and the longs are being held by weak traders, and what keeps this market from advancing is that these traders they get so nervous, and every little couple ticks up, they got something to sell. And it just kind of restricts the market from going further. So then the market breaks, and as we know, on the break, there was no real downside follow-through. Very mechanical, exactly to 1240, but it was enough to get rid of the weak longs, replace them with some new buyers. So once you get, if you have a market that has too many weak longs, by breaking and getting those weak longs out of the market, you can actually strengthen a market, because that selling power, it's gone. It's been reduced. Just as a short covering rally many times can weaken a market. When a market is short, it's got some support, because the only way a short can get out of his position or get out of their position is by buying. So when a market's too short, you have that potential buying power underneath the market. So a short covering rally can weaken a market because it removes that potential buying power. The opposite takes place if a market is too long. The reason we say a market has to break before it is rally, because the break actually strengthens the market by removing some of the weak hands holders of that inventory. Okay, now that wasn't what was scheduled today, but before I go on to the next things I want to talk about, let me just for a second focus on this idea that short covering can strengthen a market, and short covering can weaken a market, and long liquidation can strengthen a market. Is there anybody not clear on that?
We can wait a second. We don't have anything right now.
Okay. So now, when the market gaps higher this morning, you want to go with that gap if there's no give back. And early on, when you watch that market for a short period of time, there weren't any sellers at all. So you just want to blindly, as a trader, and I'm not talking about an investor, but as a trader, you want to go with this move. And I would give this thing, you had maybe 4 or 5 minutes to kind of make that decision. And once that happens, you can go with the long, and you can put your stop relatively tightly under that, because when it's set there for 4 or 5 minutes and it hasn't gone anyplace, you've got a pretty good chance that the sellers aren't there right now. Julia, is it possible while I'm talking here to replay the early start of this gap this morning?
Yeah, I sure can. Just give me a few minutes to load it.
Sure. Just tell me when you're ready. Okay. So then, as we say, no matter what the trade is, you use the references that we're going to be talking about today to monitor for continuation. One of the most important things that you should learn and spend a considerable amount of time with is this idea of monitoring for continuation. And the reason for that is most people are hesitant to get into a trade. And that can be a killer. And then they get frustrated because they passed a couple trades that worked, and they get frustrated and they do a trade that they shouldn't have done. If you grasp how to monitor a trade for continuation, I think you'll find that you'll be more comfortable entering trades. Remember, If a trade is really obvious to you, it may not be a good trade. The better trades are going to be somewhat masked by other things around it. So, and that's when the opportunity comes. If you have an understanding, like for example, when this gap's higher this morning, there's a lot of traders that are they're petrified. Oh my golly, I can't buy this market 8 or 9 handles higher or whatever it is. Oh my golly, think of the risk I got. It's up 8 handles. It could go back down there in a split second. So that brings them to a standstill. They don't enter the trade. I look at something like that and I say, okay, I know there's a lot of people, a lot of shorter term traders thinking of that. Well, if that doesn't happen, guess what? The momentum traders are going to come in and they're going to buy that market. And remember, the bigger the gap, the greater the odds that the gap will continue, at least initially. The reason for that is the larger gap, and a gap is a reference, incidentally. The gap is a reference. The larger the gap, the more dislocation there's going to be among traders holding positions. Okay, so now you're monitoring this for continuation, and the first thing you need to have happen is you need the market to trade above the 2-day high, and you need to find acceptance, and then upside continuation. So you got that in A period, you got a little pullback in B period, and then you got another run. Now, that run was associated with crude oil. And all I'm doing is, I'm not telling you to trade based on another market. I'm only trying to deal with the reality of what markets do. It's not helpful to put it all in terms of numbers. It's just understanding of what markets do. So then the market rallies. You get an inside bar in C period. Following that inside bar, about the same time that happened, the crude oil report came out and crude started to soften, eventually going to the downside. Confirmation of what I was saying earlier, that I believed this run up to the upside was mostly predicated on crude oil. You see that the market broke. You have the inside bar, and then the market broke to the downside in D and early E periods. Now, here's another thing that you have to appreciate. It's easy when the market is breaking like that. Your impulses are to get on that short. You're just kind of leaning forward in your chair. In a lot of cases, want to get that short because, boy, you think this is the big trade. Well, remember, you didn't get down to the low. You barely got back within below the 2-day high, and the market just kind of stopped. The chances at this point of getting lower value are pretty minimal. You then look back over at crude, and what you would find that crude had turned 5 or 6, whatever it was, cents to the downside, and now it's turned back up. And it hasn't gone up that far, but it's as soon as it turned back up that took the pressure off the sellers, and the buyers came back into the E-mini. The big thing was on the break, if you think about the chances of being able to get into yesterday's value area or even get out the early morning low were very slim. In order to see that, you have to get outside of just being fixated on price. Okay, Julia, let me take any questions that may come just on what we've covered so far. I'll go to the references in the slides in just a minute, but I wanted to cover today what it's right in front of us.
Did you have the thought that the A period tail was too long? You know, in other words, too many single prints and would be revisited later as I did?
Yeah, it certainly, well, yes, I had that thought. And so, okay, now we're going to go to Jim's mind and whoever asked that question. I want to be very careful here. I mean, I've been around a long time. I thought the tail was a little too much, but I said it's probably not over because these things normally run their course. I was looking at crude, but then between the tail being probably too long, I'm not, you know, it's this kind of day and it's this trader, you don't know what's going to happen. But then when I combine that with the low volume being 386 during the first half hour, okay, I then did elect to fade this market. And I'm not trying to, you know, it's a little sophisticated at this point in the game, but my discipline is that I can get out of things pretty quickly if I'm wrong. And I faded the market by buying the 2365 puts. So I've got a combination, too many single prints stretched out in A and B period, and I'm watching the report on crude oil come back down. So at that point in time, I said, okay, I will test my theory to see if in fact I'm going to get the liquidation break because this was so predicated off of crude oil. I got the liquidation break. The market paused just above these two highs. If there was real selling, it would have cut through there like crazy. It didn't. It just kind of paused. So as soon as it hit the 2-day high, I'm out of the trade. I'm over. It's over and done with. And again, but that's me. And you can say, well, Jim, that's not what you teach. It's a trend day. It's a trend day up, and you faded it. I have rules, but you know they're more guidelines than anything else. So yes, to go back to I gave a long, complicated answer to the question, but remember, I combined it with the volume. I combined it with crude, and now we're asking. This is a Kickstart program. You know, it's trying to bring people up to speed when we get into the May masteries portion, and that's an awful lot to expose you to this early in trading. But as I've said so many times, one of the reasons that it's so difficult for traders to start and be successful trading is you have to compete against the best traders in the world because the success ratio is so low. So what happens, we keep washing out traders that don't make it, and what is left is really fairly sophisticated audience. Now, that can be very scary. On the other side of it, I've been around a long time, and it is seldom that I see these big traders that don't eventually blow up because they start to get some kind of cognitive bias and fixation on what they think is going to happen or looking for the big home run, and it doesn't. So that's the good part. My history tells me that most of these traders get carried away with themselves and they get punished before it's all over. So there is room for us that can learn some discipline. Okay, let's take questions just on what we've covered so far. Then we'll see if Julie is ready to give you a look at that opening and why it was an immediate buy. Okay, questions on what we've covered so far, Julia?
As a beginner, is it better to just try to do one good trade per day, or should we try to trade multiple times on days when there are more opportunities, like today, as compared with yesterday, which was mostly chop?
I have two answers to that. One, I generally look for a couple of trades a day. I had a pretty good day yesterday. I did 3 trades. They weren't home runs, but they were meaningful trades. But the more important thing is don't set a number. If the trade comes to you, do the trade. Do not, I mean, you'll hear me say this over and over again because it really doesn't register with a lot of people. If you are looking for a trade, it is probably not a good trade. You want the trade to come to you. Now, you're only going to recognize that trade has come to you once you have a level of experience that allows you to do that. For example, this morning, when this market gapped higher, my experience, I'm watching this and there's no give back whatsoever. It is not a hard decision for me. When I was first starting to trade, man, I'd have frozen like crazy here. Oh my golly, we've got a very prominent point of control down here. Oh, this market's up substantially. I can't go chase this market. And it was only as I gained experience that I started to be able to comfortable to do this trade. And obviously, this is where the winners are doing. This is where the winners were acting. Okay, but that's a great question. But the real answer is, if the trade comes to you and you recognize, do the trade, and if you do that, it's really not that important of how many trades a day you should do. Okay, another question.
Yes, just lost my. I really have to disagree on Jim's assessment of the S&P running with crude. On the contrary, crude went nowhere while the ES skyrocketed. The 1030 report turned them both down.
Remember, crude was up substantially. Crude was up substantially when the market opened. So you may well be right. That is my assessment. My confirmation is the fact that when the crude report came at 10:30 Eastern time, it turned both markets down, was more of an indication to me that the market still was following crude. And then it turned up again as crude turned back to the upside. But again, you're always welcome to disagree. I am not, in no way in the world do I think I have all the answers. Anybody that thinks they have all the answers to trading is going to be very, very deadly and very dangerous. So, it may well have been. It was the gap. The gap gets the momentum traders going. The ADP number was wonderful, and the market went. So you well could be right. All I'm reporting is what I saw and what I was reflecting on. Okay, another question.
Yes. Today's first 10 minutes were very low confidence. The market rotated 6 ticks up and down with no direction. Then it broke a little range and shot up. I honestly started thinking low confidence gap.
Okay. Are you ready to play today yet?
Are you ready to play today yet?
Can you replay the day?
Oh, yes.
Because I'll talk about that. That's a great question, and I'll talk about that question and answer that question as Julia replays just the first few minutes of today's opening. Okay.
Okay, and we have several other questions, so everyone sit tight, and we'll maybe some of your questions will be answered as we look at the replay.
Okay. And incidentally, we set an hour. I'm not fixated on any time. As long as Julia can stay and as long as I can answer questions, I will be more than happy to do that. The importance of the Kickstart program is too much, so I'm not going to tie it to an hour. Okay?
Okay. You can see my window trader. Okay. Anything you want me to mark here, sir, before we get going? Want the unchanged? No. Okay.
No.
I have it starting at real speed.
Good. Okay. So we're seeing right at the top of the overnight high, which we know is a dynamic reference or a static reference once we open. So now the question people are saying, well, and keep an eye on the clock in the lower right-hand corner. You're saying, well, this confidence is pretty low down here. Okay, view the confidence slightly different. If you take out any of the surrounding context and you're just looking at what happens following the opening by itself, you're likely to arrive at the conclusion that confidence is low. However, if you wrap in the underlying context that this market has opened substantially higher and there is no meaningful indication of sellers being able to come in and have their way with the market. That's what I was looking at. I'm saying the sellers aren't able to get anything out of this market. And, when the market opens this much higher, if there were serious money there saying, boy, this is the chart I was waiting for, that market is going to open and it's going to start down pretty quickly. It is very common that there are a lot of overnight traders that are long and short-term traders that automatically will sell any higher gap because that's what somebody told them to do. Okay, so now the market's back to the opening, pressing on the opening, and we're right. We're only 2 minutes into it, right, Julia?
Yes, 9:32 if you look in the upper left.
Okay, so 2 minutes has gone by. $13 contracts traded at the opening. They're pushing on the opening, pushing on the opening. So the big thing remember in here is that if long-term money said, boy, I got a chance to sell this market at above the highs of last week. Boy, thank you very much. Guess what? There wasn't anybody there. Now we're into the market. We're almost at 3 minutes, right?
Yes. Well, we're still at 32, but yep.
But like I said, I don't remember the exact time, but I'm looking at this market, and I had about 4 or 5 minutes, if I remember right. I had about 4 or 5 minutes to make my mind up if I wanted to take a trade to the long side of this market. And as I'm watching this thing, I'm saying, there just are no sellers in here. And if there's no sellers in here, let's go. And so someplace in here when it's not getting anything on the downside, I went with the 70 calls. Again, it's somewhat of a crapshoot. Yeah, it is. But that's what trading is about. It's once you're certain, it's pretty late in the game. So the market's now been open. We're going almost on 4 minutes. And we're getting nothing on the downside. Getting absolutely nothing. And you look at the volume down there, 31 counter. They're pressing. We're going into the 5th minute, 4 minutes and 4 seconds. At this point in time, now, if I'm long, what I'm going to do, I don't want this market coming more than a point, more than a handle, back through the opening. I mean, it may go a handle lower, and it may have been, to come out of the trade, may have been wrong. But when I'm looking and monitoring for continuation, I don't want it back through that opening more than a handle. Okay, so now we're at 4 minutes and 35 seconds.
Well, actually, that's not accurate. That's my clock. It's still 9:34. We can't see seconds on replay.
Oh, okay.
Upper left corner.
Oh, okay. So how long we been here now?
9:34. Still here. Still in the 4th minute. Okay, we just rolled to 9:35.
I remember what I said. I mean, I didn't look at the clock, but I said, and I looked this morning and I said, I thought I had 4 or 5 minutes to make my decision this morning. It wasn't something that I had to I had to, do immediately. So you're feeling in here, and I can understand how this can shake it, because you're feeling it. What they're pushing. What do they got? You still got 31 contracts on the low. So the people that are selling are those that automatically sell because price is higher. You got those that were long overnight and want to take some profit. But if you had any real-time activity in here, you're not going to sit there this long, I don't think. Sometimes I'm wrong, but trading is about making decisions, and you're trying to go with the best information that you have. Okay, and as soon as this thing starts to extend to the upside, then we'll go back and answer some more questions, and we'll eventually get to the slides. But just give it a little more time here. But you see how this wears on you? I mean, but see this thing, I understand somebody says, I'm reading it as low confidence. And I'm doing the opposite. I'm reading it as high confidence. I'm reading it high confidence from the long's standpoint. Now, if I didn't have a gap, if I changed the context and this range took place within the center of yesterday's range, now I would agree with you. I said it's a very low confidence surrounding the opening. But now change the context and put it gap higher, as big as the gap is. Now I say, wait a minute, the buyers are fairly confident. The sellers can't put this market down at all. And I don't even know how many handles higher we moved. It must be 10 or 11 or so.
Okay.
Pardon?
5 for the gap today.
No, but for where it is right now. Okay. But anyhow, that's what I'm looking at. Now it's been here. I guess it was there longer than I had remembered.
9:37 Eastern.
Okay.
The gentleman who asked the question prior to us immediately starting the recording said, I anticipated after such low confidence open that we are going to stall in a narrow range for the rest of the morning.
Yeah, I when you gap this much higher, it is rare that it just goes up and sits there and does nothing. Can it happen? Of course it can, but it's not the first thing that comes to my mind. The first thing that comes to my mind is to see some volatility before it's over. I had no idea it sat here this long. Okay, all right. Let's go. We'll just leave this play. But I mean, there's nothing wrong. All I'm saying is one person saw it one way, I saw it another way. And the thing that I was talking about, if you wanted to sell, you certainly had an awful lot of time to make that decision. And, we're 2 ticks, the lowest, it's gone 2 ticks through the opening. Okay, we'll leave this play until it makes the run to the upside. Other questions?
Is today's first hour a kind of stop hunting? Is there a way Market Profile talks about possible stop hunting?
I have no idea what that means.
Well, I guess when, on the floor, you said in Mind Over Markets that, they would probe lower, wait to see buyers come in, probe higher, see sellers coming in, and now the floor traders had their envelope, they had their edges to go to work. So maybe it's not stop hunting per se, but
yeah, I don't know. I mean, we're everything's so much electronics today. I really don't know. It's not, you're not getting enough rotation back and forth to resemble what used to occur on a trading floor. Like I said, the biggest thing I'm looking at is the market opened this much higher. Overnight inventory was short and it ended up being long by the time we opened. There were no sellers. 2 ticks down prior to the opening. So I saw there's a little difference in confidence. But, you know, when I look now how long it was out there, I'm amazed. I just, you know, my clock wasn't working that well. It's been there a long time. Okay, additional questions.
Why not just trade the S&P and ignore crude? What are you going to do when the market stops following crude? And we've had a couple of questions about that type of question.
Okay.
Why does yes trade against crude, etc.?
Those are wonderful, wonderful questions. And, you know, in most cases, when people ask about what follows other markets, you know, what other markets affect this, my standard answer is just spend your time trading the market that you trade. Read what's going on in that market. What you'll find is I've always had a caveat to that. And the caveat has always been, if there's going to be impacted by another market, it's going to be under those circumstances when the other market is acting at extremes. Extreme breaks to the downside, extremes breaks to the upside. And if you take a look at crude, you see that, you know, it gapped higher and it was a really very sharp move this morning. And $50 has been that kind of magical number. Again, excuse me, I don't trade in a vacuum. So when I don't trade in a vacuum, then I'm aware of other things going on in the market. I'm not overly weighting them. But again, remember, there's nothing, we've seen no indication of long-term money on the buy side. We've seen no indication of long-term or sticky money on the sell side. When there is no dominant participation by longer-term money, the market remains in the hands of the short-term traders. Short-term traders they're always looking for something to follow. Oh, one day it's the crude, next day it's the dollar. So you've got to come back. You've got to come back and understand the context. If in fact we had indications of strong trend up and longer term money consistently entering the market may not pay any attention whatsoever to crude oil. Might not pay any attention whatsoever. Now, traders that have gotten in the habit of, you know, making decisions based on crude, they'll get run over and it'll make their life much more difficult. And, you know, and one time crude going up is bullish, another time crude going up is bearish. So there's no consistency over a long period of time. It's just what traders are currently doing. And believe me, it's a lot of times, as I said earlier, people would like to make more sense out of the market. They would like, we talked about this need for closure. We'd like to have more absolutes. They don't exist. And that's all I can share with you. But you're generally right. Generally, trying to look at crude to decide what to do with the S&Ps is generally a bad decision. But when the context is that all we have are short-term traders in here, you got to be very cautious because that's what they might do. Okay, I beat that to death. Another couple questions, and sometime I want to get to the slides.
I was expecting a trend day up, especially that the NASDAQ broke to all-time highs. What really showed you that it might not be a trend day up and that it was okay to fade? The nice volume in the crude?
One, okay. Remember what I said was, somebody asked were there too many single prints. For as slow as it was gets started, there were an awful lot of single prints. Then I went and I looked at the volume, and the volume was 386. Anybody that's been around know that in the 380 level is pretty puny volume. So that alerted me. So many times, traders can't get away from price. The price is just this tremendous influence on a lot of traders. And boy, it looks like a trend day. And well, you know, the odds are a trend day when you've got the, when you're coming out of the gap of that nature. But, you know, it's one of those things when the market was following through. So at that point in time, I was in touch with the market. The volume was a big one to me. The two stretch out A and B period. I'm going to go back to my, can you give me back? Let me take the screen back.
Sure thing.
Thank you, Julia.
I'll stop the play, but we can come back. I won't, you know, I'll keep it loaded.
Okay, the excessive runs in A and B period combined with the lower volume was the alert that went off in my mind. And I'm going to guess that a lot of people, they get so mesmerized by price and their expectation that they forget to be able to look at those other things and incorporate them and say, you know, because the volume was low, does that mean we're going to break? No. But what it does is it increases the risk of being long, and it increases the potential for the market to have a setback if crude sets back. Now, one of the statements I make all the time is do not trade the economic releases. However, you do want to know at what time the release is coming, because there a lot of times will be trading volatility around the release. And of course, so I'm watching this market. I know crude is already up. I know it's pretty well priced for perfection. The S&P volume is pretty low in my opinion, and crude comes out and the report starts to tank crude. And at that point in time, you know, it didn't tank. It just kind of would go down and would come up, go down and come. But at that point in time, it just felt like it was a good odds play. No love. Not in love with the trade. As I said, as soon as it got back down to these highs, I was on because the tempo was very slow down here. Okay, other couple questions before we go to the slides.
Yes. I bought a put at 2374.50 and bailed out when we found downside resistance at 2371. The low volume and downside conviction spooked me out of what was the correct indicator of downside. Did the low volume and downside conviction spook me out? I'm sorry. The low volume and downside conviction spooked me out. What was the correct indicator of downside continuation?
You know, the things that came to my mind. Look at the C period pullback. Again, now we're into references. We're into dynamic references. Dynamic references are references that develop throughout the session. So the C period comes one tick above the early A period high. Okay, and that brought the buyers back in. Okay, that caught my attention. Again, we're always talking about how do you look at a market, and if the market had to go back to exactly one tick above the A period high in order to find buyers and go back up, that to me was another indication that the buying activity wasn't very strong. And I'm also at this point, I can pretty well take a guess that we've got some long inventory in here. And there's a lot of single prints. A and B are stretched out considerably. So I'm watching this, and I understand exactly what you're saying. It would have been very easy to get shaken out of this trade. And I thought about it. I thought about the trade, but I said, no, I'm okay. I've got a fairly decent trade location. I'm willing to take a little risk, give it a little time, and I'm watching crude. And then, so that's this really, it's so many times we don't give trades enough time to work. Once we get into a trade, we want everybody else to see the trade as we see the trade. Most people are not, if you really learn how to read order flow in the market, read the structure of the market, you're going to be ahead of most traders. Remember, a lot of times, particularly short-term trades, the best short-term trade very often will fly in the face of the most recent market activity. So when it's taking traders longer to realize what you've realized, all of a sudden that can shatter your confidence. So we say monitor for continuation. So, if you're going to do that trade, and I don't know exactly where you got in, but you're saying, okay, you want to keep the high. Okay? Now, when it broke, there wasn't any real conviction on the downside. There wasn't any real conviction on the downside. And like I said, it was pausing right here, right at the 2-day high. Finally got the stops and got through it, yeah, but it was pausing. There wasn't anything there. And to me, it's just a simple out. Okay, 2 more questions.
Yes. Give me a second, everyone. Jim has noted in the past that the auction linked to another market, crude here, reflects a weak market. Lower volume reinforces that weak market assertion. It seems as though we are rotating as a result of many days of rally.
Would you read that one more time?
Jim has noted in the past that an auction linked to another market, crude in this instance, reflects a weaker market. Lower volume reinforces that weak market assertion. It seems as though we are rotating as a result of many days of rally.
Well, we haven't had many days of rally. You got to remember, we broke on Monday. But I think the first thing is this comment. It's rather than a weaker market. Remember, I set the context early on. There's just no indication of any longer-term sticky money on either side of this market. However, there's no indication that the longer-term money has started to be sellers. Now they've been long. Most of this money's been long in the market for a long time. There's no indication that they've decided to sell. So, you got to take that and factor that in also. Again, it's dealing with the realities of what's going on. And right now, there's nothing going on in the market. Now we look today. The market's still up here. It's almost 10 o'clock. In an hour and 7 minutes. Now we're going to get the FOMC minutes. So that may add some more volatility to this market. Again, if I look over here, my guess is we're going to see that crude isn't up that much, but it's still holding a little bit. All right, let me go to the slides because they are important. And references. We got 2 types of references. We've got static or stationary references. And these are thinking slow references. The static or stationary references, they've occurred prior to the market opening this morning. You have a chance to think about them, review them, mark them on your trading sheets. With that slow thinking, deeper thinking without having the pressure of having price jumping back and forth. So they're very important references. Dynamic references, these are thinking fast references. They, as we said the other day, thinking fast doesn't mean panicked thinking, doesn't mean impulse thinking, but it's processing information, realistically as to what's going on. It's like I said this morning. What was I processing information this morning? I've got a gap. There's no real sellers, or we wouldn't hold, right about where the gap opened that long. Then I'm processing that volume was low on the upside, and I'm processing that C period came back to within a 1 tick of the A period high. So I'm processing that information. I'm going through that and processing that information, thinking about those things. Now ask yourself, how many people out there have forgotten about that, and they're so busy reflecting on price moving up and down? You don't have to answer that, but I'm going to guess that there's an awful lot of people, that's what they were doing versus what I was doing, and how we both processing information probably are quite different. And you really want to get to the point where you have a little deeper understanding, even in the very short term, of what is going on. Static or stationary references would be unchanged from the previous day, overnight high and low, previous day's high and low, previous prominent, and very prominent POCs from the day before or multiple days, the high and low of gaps, weekly high and lows, monthly high and lows, trading range high and lows used for ranges more than 3 days in duration. So that may be high, that is you're looking for, maybe a little broader trading range. And then you're looking for short-term trading ranges. So for example, an inside day, a very narrow inside day, can be a short-term trading range. Yesterday was a fairly narrow inside day, fairly narrow range. You could have 2 overlapping days. So again, it's thinking about the stationary references, and you can do this, remember, you can do this slow thinking, and you can think about, how did the reference form? How did the market get there? And it's important to label these on your trading sheets. Stationary or static references, there's more creativity regarding these. Right here, what I'm trying to show here are some more creativity. Remember, we've talked about pullback highs and lows from trend days. I will promise you there are not many people that even give that any idea. Okay, you're looking at 2-day balances, and you're looking, are you in or out of balance? Single prints that separate on a double distribution trend day. The single prints are a form of excess. So I treat each of the distributions as separate days or auctions. Anomalies. We saw, and I'll come back to it in just a second, we saw as the market broke on Monday, people noted that there was one anomaly up near I think it was the C period high. And I didn't pay much attention to it that day, because it wasn't affecting me right now as I was reading the market. But clearly it was there. If the market had that much, conviction on the downside, you probably wouldn't have had that anomaly up there. Okay, now, and I'll go back and show you that anomaly in just a minute. Number 5, when we were going through these slides last night, Julia came back and said, Jim, you ought to put in there labeling references relative to your personal time frame. And I think that's a very wonderful concept, because if you're a short-term trader, an inside day, the high or low of an inside day is a pretty significant reference to you. If you're a longer-term trader, you're going to be in the market for several days at a time, you might care less about the high or low for a single of a inside balancing day. So again, it's so much of what we do here is relative to your time frame and how you see the markets. Now, people are always asking, and I don't know how many times, was the other time frame trader here? Did we have long-term money today? This was the big gap up. It must have been long-term buyers. Big gap must have been long-term sellers. And, it's people are overly obsessed with that. But if you notice, when we are looking at a day or getting prepared for our trading review in the evening, we start with the monthly chart. We look at the monthly high. Are we one time framing higher, one time framing lower? We look at the, are we in balance? If we're in balance, let's say we've got a 4-month balance on the monthly chart. We've got a high and low of that 4-month balance. Those high and lows are pretty significant. And trading that takes place relative to those references are more than likely longer time frame, longer than day time frame, longer than swing traders. Doesn't have to be, but if you've got a 4-month high and there's sellers at the top of that 4-month high, more than likely you had at a minimum serious swing traders coming in, maybe even longer term traders. At the low of that 4-day balance, 4-month balance, if money comes into the market, more than likely it's not day time frame, it's more than likely at least more serious longer term commitment. It may be swing traders that are in the market for a period of time, but it's, you mark those references and more than likely it's going to be far more serious. And what happens at those references? And remember, the way the day and short-term and other short-term traders operate is if you get to one of these major reference points, say you go to a 4-month high and the market sells off, almost every other time frame piles on and starts setting the market lower. Now, that may dissipate as prices go lower, but early on, there's a piling on effect if the other time frame, or we look at the high or the low of a 4-month balance. So again, it's something to consider that they're going to be piling on. So it's very important that you do understand who is likely to be at these references. Of course, then you go down and you got the weekly high and lows, and then you can, and right now we have been one time framing lower, but last week's high was not that far off of the week before, etc. Well, what happened today? Today we changed. We are no longer one time framing lower on the weekly bar because today took out the last week's high and it took out that one time framing lower. Very significant thing that happened. Now, it may not be lasting, but it's certainly something you should expect. And once we got the last week's high, pretty good chance that you're going to get some short covering or hit some stops at that level. So this idea that, think about what Julia said, clearly we could probably all agree that a monthly high probably ought to be labeled as a more important, longer time frame reference by all of us. A inside day high or low is going to be relative to the time frame we are trading. Dynamic references. Dynamic references, these are the references that are what really makes a trader throughout a day. These are the type of things that you have to be continually processing with your fast thinking. Again, don't want people to mistake fast thinking for panic or emotional thinking. The opening, half back, poor highs, poor lows, POC, migrating POCs, developing value area, double distributions, anomaly, and developing two-sided trade. Remember, any trend day is looking for a level where two-sided trade can take place. Like any business, nothing happens until there is two-sided, nothing really builds your business until two-sided trade takes place. If you take a look at any bar chart, you will see that most trades, probably 80–85% of the time, most trades happen within trading ranges. And so that's where two-sided trade is taking place. Okay. Attention getting structure. This is by far the most complex and difficult to comprehend for most traders. After a while, it becomes second nature. This is subject to the chunking concept. And remember, what I'm talking about, let me just review chunking. It's a psychological term, and when I first saw it, I said, that's BS, and I went right by it. Well, as time went on, I started to appreciate that chunking is very important in the process of becoming a professional trader. The analogy that I've constantly given is the first time you back out of a garage, you back out pretty slowly. You know, you put the key in the ignition, you put the car in gear, you look over your shoulder. Multiple times you inch back a little bit, you stop and check again, you inch back a little bit, stop and check again, head's going from left to right. The more you do that, the more you are prone to speed that up. And when you speed it up and it becomes more like a fluid motion, at that point in time, you're really chunking that information. The brain is basically lazy, and the brain loves to chunk information and take the easy way out. We couldn't go, from the bathroom to the bedroom to the kitchen without chunking. It'd take us forever to think about every step. So it's a necessary part, but it's easy to make mistakes within the chunking concept. But the example I was trying to give the other day is you want to get to the point. You want to get to the point where you really do start to look at the situation and see information very quickly. I think I used the example the other day, and I don't know if the number's exactly right, but a professional baseball player has like 3 or 4 millionths of a second to make that decision to hit the baseball. I may be off, but I'm not off by much. And what happens is when we look at markets, we get faster and faster at it. Let me go back and give you, let me come out of these. And give you a sample of that I thought was pretty important the other day. This was Monday, where the market made a sharp break to the downside. As I pointed out, the point of control, 3, 4, 5, 6, it was eventually 8 wide before the day was over. That point of control for a day time frame trader became very important for short-term trades. You remember, if you were with us, when it first developed, the market had rallied to, there's the H period high, exactly half back. And I said when it broke below this, it was getting short in the hole. There's the fairest price. They're selling below fairest price. Then we got the short covering rally, and when the market rallied up here, I said we had the other effect. We were selling, buyers were buying above fair value, getting long at poor prices. But the importance isn't to understand that. The importance is I've talked to a lot of people over the last few days or heard emails from people that never recognized this developing point of control. Never dawned on them. And afterwards, I said, my golly, I have to explain it. It's right there in front of me. Why didn't you see that? You didn't see it, one, because you haven't learned to chunk information, but you're too mesmerized by price and watching price movement. Remember, price is an advertising mechanism. Okay, we've gone on quite a bit. There's, I'm sure, room for a tremendous number of questions. Let's go ahead and let's open it up to questions for a while, Julia.
Sure thing. Okay. With a 5-point gap this morning that takes out the volume POC from March 31st, would you be thinking of a gap fill as it does 65% of the time.
I don't know. Where did the figure come from that the gap is filled 65% of the time?
Maybe it's, you know, market
I
lore.
have no idea. I can't respond to that because I have no idea what that number is.
Okay. Come back to you if you want.
I can say in a broader sense, this is a key. The bigger the gap, here's what's more important to me. Rather than statistics of how many times a gap is filled, first of all, just to make sure that everybody understands in the language that we use, a gap to us is only when the market opens above or below the previous day's high or low. It's the only gap we recognize. A gap to me is outside of the previous day's range. So that's one, just to make sure we're clear on the definition. Secondly, the smaller the gap, the greater the odds that that gap will be filled. The bigger the gap, the lower the odds that that gap will be filled. Now, let's explain that. That's mystifying to a lot of people. It's intuitively, it doesn't feel right. Intuitively, you keep thinking, well, the bigger the gap, the more likely there's going to be sellers that'll fill that gap. The reason it's not right is trading is about change. When you gap, the bigger the gap, the bigger the change that has taken place. And if the gap is higher, for example, the more people that are likely caught, so you have people that were caught short, they have to cover their short. It generates margin calls, so they may have to, a lot of traders trade on an undercapitalized basis, so they have, the only way you can cover a short, you have to buy in order to cover a short. They have to either meet the margin call with cash or cover their position. Most undercapitalized traders we're going to liquidate rather than trying to raise cash. The next thing that happens is the bigger the gap. There are a lot of systems out there that are based on price movement. The bigger the gap, the more likely some price-based system, if it's the upside, will trigger a buy. So the bigger the gap, the lower the odds that we will see the gap filled on that particular day. The smaller the gap, the greater the odds that the gap will be filled, simply because there's not that much dislocation or distortion. Okay, another question. Julia.
Yes, pardon me, everyone. Would you, and I know you don't like these types of questions, but I want to speak to your thought process, okay? Maybe I'm just being passive aggressive. Just kidding. Would you have gone long the E-period low, or were you too spooked by oil?
No, matter of fact, I think that in hindsight, it's pretty hard to say, but the E-period oil, I would not have gone long. I'm sorry, E-period, I would not have gone long simply because I'm coming up and I have to do the Kickstart program this morning. Had it not been for the Kickstart program, I think there's a pretty good indication I would have gone long this morning. Because as that market was coming down, it was just the tempo was pretty slow. And it punched through this, there was no exception. So my guess is I would have, but again, that's conjecture unless you did it. I can't say. More than likely, I would have, but I can't say for sure. Okay?
You had that high reference, too, to place your stop. I mean, the March 30 and 31 highs, so you had somewhere to, place the stop.
If you're going to go long in this E-period break, the question then is monitoring for continuation. So the first place is where you're going to put your stop. First place I'm going to put my stop, I'm going to put the stop pretty close to the low down here. I'm not going to let it take that low, because that could bring in some serious selling. Now, remember, maybe you don't remember because maybe you haven't heard me say it. Very seldom do I ever get taken out by a stop. Now, granted, when I trade options, you don't have stops with options. You get killed. But even when I trade futures, if I trade futures, I will always have a stop. I will very seldom be taken out by the stop. If I want to build confidence, I want to come out of a trade by my own power. So for example, if my stop was down here right around the opening or a little below the opening, that's my fail step. Now, monitoring for continuation, if I'm long in E, if I do buy an E period someplace, well, how do I monitor for continuation? I've got to get back up above the 2-day high here, and then I have to start to show some acceleration to the upside. What is more important is if I become proficient at managing for continuation, I won't need my stop. I will come out of my own power. So if I do this trade, what I have to do, I have to get back above the 2-day high. I have to leave some buying tail down here, and I have to start to get back and show some upside continuation. The most important thing is if you can learn and understand how to monitor for continuation, you will be able to make far more trades. Like somebody said, or were you spooked out by this? Yeah, if all you're doing is following price and say, wow, look at this, it's very easy to get spooked out. Say, oh boy, it could take this, it could take this, it could go all the way down to the point of control from yesterday. Oh, I can't go long here. But if you think about, wait a minute, how to monitor for continuation, you can take that trade. You know this is your fail stop down here. You know how to monitor on the upside. And if you don't get much lift, you just come out of the trade. Okay, good question. Other questions, please.
FOMC is today. How important is this for your trading plan today?
Oh, it's very important. I don't want to have a position. I don't want to have a position as the FOMC announcement comes out. Number one, it's a low confidence environment anyhow. If the market comes out, there are 3 things that can happen to me if I'm in a trade. 1, I'm helped by the trade. 2, I'm hurt by the trade.
By the announcement.
1, when the announcement comes out, 3 things can happen. 1, I'm hurt by it. 2, I'm helped by it. 3, nothing happens. It's kind of a random event what they're going to say in the announcement and how the market's going to take it. Why? That's not good odds. A 50-50 odds, doesn't make a lot of sense to me. Now, let's change the context. Let's say that I had a very strong trend to the upside. I had a very strong trend to the upside, and the FOMC announcement came out, and it gave a setback to the market. I might step in and be a buyer saying, okay, it's a strong market anyhow. I'm looking for some kind of little negative news to get onto the trade. So again, context will change an awful lot of things. Okay, but today I've already said that I don't have any confidence in this market either one direction or the other. I don't have any context and confidence in the market. Why should I have a position going into the FOMC? Why not wait and see if following the FOMC meeting, the market presents some kind of an opportunity to me? Okay, thanks. Another
All right.
question.
Thank you, Jim. I did a decent job this morning and patiently waited until 9:41 Eastern to buy at 64.50 with an initial target of 69, which was a micro composite high volume node. I think that's what HVN is, assuming it would get over the poor and weak high at 66.75. My big issue is staying power, which relates to trading as low confidence quote unquote. But I almost think it's just because it's just become a bad habit. I understand the concept of replacing a bad habit with a good one, but struggling to accomplish this process. Any thoughts on how one can make progress on this issue?
It's this idea of being able to put the trade on and manage for continuation. So when you put the trade on, you may have an objective in mind, but you have to have the flexibility to say, okay, so this happens, it gets accepted. So if I had a stop down here, it now gets up and it gets accepted above the 2-day high. Now I'm going to drag my stop a little higher. Give me a little protection, a little security. I want to see if this point of control, I want to see the HE period high taken up. I want to see the F period high, or at least move sideways. Again, if you did this trade, it's one time framing higher, values clearly higher on the trade. So again, it becomes a still tied to managing for continuation. Now, Julia has traded with me, and she knows that what I just said isn't necessarily what I do all the time. So if I bought an E period and all of a sudden I get a sudden spike to the upside, Julia, what might I do?
Yeah, I think we all know who follow you. You'd get out on the flush up. Too far, too fast, and take your money and take another look in a little while.
Yeah. Now, almost every time I do that, had I waited, I could have gotten out of the trade at a better price. However, the agony, as I sat and watched that for an hour or two, didn't make it worth it to me. So again, if the high confidence market, low confidence market, if I'm sitting here saying I'm looking for a day trade, so if I get on this trade and I get a fast spike to the upside, I may just take it and step aside. And I'll take another look at it later. If I'm watching a little more carefully and I'm saying, okay, if it one time frames higher, I'll go. I'll stay with the trade. Or I'll stay until it just appears to be very, very sluggish. I don't have any hard and fast rules. But if I'm doing short-term trades and the moment seems to be excessive, I'll just take it and step aside. Then I'll come back and I'll look at it again. I'll look at it again later. Okay.
I can remember. Oh, go ahead. Sorry.
Go ahead. No, please.
Well, no, I can remember some trades where we wouldn't talk about trades per se, but we would both be long on occasion, and Jim would say, I just exited, and I'd say, I'm still in it. I think it's going lower. And, monitoring and sticking with that trade, it goes up, it goes down a little, it goes up. Oh, maybe I should have gotten out. And the psychological capital that I expended to try and squeeze that trade a little more, I'd look over at Jimmy, just be laughing at me, say, you're exhausting me just watching you monitor that. So I have learned that it works for me too. Just get out, be happy, move on.
Yeah, and so much of it is reading the day. I mean, if you're clearly in a nice, solid, high confidence trend day, leave it alone. Get your hands off of it. Leave it alone. You got to take the context in play. Context is always in play. Okay, another question.
Yes. Do you find that the volatility / volume contraction during the lunchtime period, 12 to 2 p.m. Eastern, has an effect on the market profile, and how do you account for it?
Julie and I have argued over this point for a long period of time. I do not pay any attention to what's called the noon hour, because what's called the noon hour in New York is not the noon hour here. And granted, yes, noon hour in New York, does the market have a tendency to slow down? Yes, but I do not factor that in. I simply try and read the market. Do I know that the market may slow down? Yes, but you watch on a trend day. On a trend day, you be very, very careful because you may get run over. You know, putting that as part of your trading plan. What I find, if I start to factor something like that in, then I find it becomes a habit, and I start, oh boy, I can't. It's noontime. I just try and read. I try and read the market, and I just caustically say, well, you know, while they're eating lunch in New York, I'm having breakfast. I try not to factor it in. Personal choice. Okay.
Is today a trend day that has turned into a rotational day?
I would say that. I mean, I think it's a good call. Yeah, I mean, right now, it one time framed higher, at one time frame lower. It's one time framing higher. We're going to change periods in 5 minutes. You know, but I don't. It's more rotational, but I don't get hung up on that because then I say, what's front and center is in 35 minutes. You know, we're going to get the FOMC report. I have no idea what impact that's going to have on the market. So, you know, I just say right now it went up, it went down, it went up so far as rotational. It's one time framing higher. I'll see if that ceases. Okay, couple more questions.
Okay, I'm with you. Hold on. How about the F period high volume around the 2368 level? Now we don't see it now because we're only doing current 30-minute period. Would you have used that as a potential area, or could you have used it to get long?
Probably not. I don't have a tendency. I don't have a tendency to look at those individual price levels, and this goes back to the point where, you know, some people are using volume profiles. I don't use volume profiles because they don't incorporate price.
Time.
I'm sorry, they don't incorporate time, price, and volume. I do have a tendency to look, and I'm saying, you know, down in this area, it's white. I didn't get much volume relative to the rest of the day. I'm looking up here, not much volume, and I'm saying in here, it's pretty high, heavy volume. I mean, I do look at that stuff. I mean, I'm aware of it, but I don't get fixated on a single price. I think when getting fixated on a single price, I think what happens, it can narrow your perspective so much that you lose track of the important information surrounding you.
Mm-hmm. Could we refer to one time framing as a dynamic reference?
Absolutely. Great question. Yeah, absolutely. Because it's developing as you're trading. Just as an inside bar is a dynamic reference. Dynamic references are these are for short-term traders, dynamic references, and being able to think in those terms, very important. Because one of the things it does, it takes your mind off of just following the little price chart going up and down. And I'll say if people are using, you know, 5-minute charts and looking at the bid ask, I think that's disastrous. If you're looking at these small charts and 5-minute charts and stuff like that, and you're successful trading, be my guest. But I'm going to guess that if you're doing that, you're probably very frustrated. You are probably not overall successful trading, but you build a habit, and it's very hard to get away from it. Because once you start looking at those charts and you see bid ask, oh boy, it's going, boy, they're buying, they're selling. Drive yourself crazy. You get very tightly focused, and you'll lose track of everything. I've been down that so many times. I've fallen into that trap so many times. Personal preference, but if you're asking me about something, first thing, go back and always say to yourself, is what I'm doing productive? If what I'm doing is not productive, then I better reevaluate what I'm doing. It's once you get those habits of looking at those bid asks, looking at those really 5-minute charts, boy, it is very hard to break. It is very hard to break that. It's very hard to get a broader perspective of what is going on in the market. And I'm not talking about, when I talk for day trading and short-term, I'm not talking about this huge broad perspective. I'm talking about a perspective that is realistic for being a day or very short-term time frame trader. You know, the volume is very important. The inside bar is important. You know, because the market was looking at crude oil today, it become, you know, somewhat of a focus. Maybe I'm wrong. Maybe that was just luck, but those are the kind of things that I'm looking at. Okay, a couple more.
The weekly chart has just stopped one time framing lower. Now, are we going back to the SPX high at 2401?
I have no idea. You know, did something change today? Yes, something changed. We looked above. We stopped one time framing on a weekly bar. I said, yeah, we did that, and we probably hit some stops there. So this would have been last week's high, right? On the 30th. And
yep.
Guess what happened? Once we got above last week's high, guess what? They got some stops in there. When you're talking about it, Julia's suggestion, you know, labeling your references instead of this being a two-day balance area high. How about the reference saying, you know, short-term balance area high dash weekly high, likely stops above this as one time frame. Which, I mean, identify the reference, give it some character. When you look at those references and you're making those your charts, give it some character so you have some idea what it means, not just a two-day high. Give it some character, as she suggested. Label it as a weekly reference, but just labeling it a weekly reference, that tells you it's more relevant than just a day time frame high or low. Okay, let's take a couple more questions.
Does Jim watch the VIX? How can we relate the CBOE VIX with the market profile?
I do not watch the VIX, no. I mean, does that mean that I'm not sometimes aware of it? Yes, sometimes I'm aware of it, but it's not something that I'm more aware of it in a broad sense than when it's extremely low or extremely high. What I know is that lower volatility tends to lead to higher volatility or increasing volatility, and high volatility tends to lead to lower or decreasing volatility. That's a broad statement. For example, I don't even know what the VIX is right now. So I find you can spend too much, you can get hung up too much on some of these other indicators, and they can bring you to indecision in the market. But again, I'm more, just like I am with crude, I'm more aware of extremes. You know, when crude got under 10% some time back, I'm very much aware of it. I'm aware of it from a different standpoint. I know when volatility is low, my options that I buy are going to be cheaper, but I know that I can't get swayed by that. I got to be very careful because cheaper price may mean less possibility of getting in the money on those options. Sometimes I like higher volatility and I have to pay more for the options. You know, again, I know volatility from that level rather than trading off of the CBOE volatility index. Okay, let's take two more questions and then we'll call it for the day, if that's all right.
Sure. Did you take your calls off the table? Do you mind talking about your position?
Oh yeah. No, I had them early. And puts got out, getting ready for not only getting ready to do the Kickstart this morning, and I've made a couple of real boo-boos by taking positions into a webinar or overnight. Because if I had a trade on, and all of a sudden I'm talking to all of you, I cannot bring myself to stop what I'm doing and exit the trade. It's cost me dearly a few times. And I just can't bring myself to stop doing what I'm doing I think it's unfair to you. And so this way, unless I'm planning to hold something for a longer period of time, when I go into these webinars, I don't have it. I don't have a trade on. As a general rule. Understand, none of my rules are absolute. Okay.
Okay.
Let's take a look. We're getting ready for 25 minutes till we come into the to the number. Let's go over and let's see. Early on, our trading volume was ahead. Look what's happened as the day goes on. As the day goes on, volume, higher prices are bringing in more activity. So once we look down below that weekly low and came back up, volume has picked up. That's a healthy sign. It's not a sign that you want to trade into. We're not overwhelmed, but volume's been very low the last few days. But at this point in time, higher prices are attracting more activity in the marketplace. Okay, one more question. Oh, I'm sorry. Before we do that, let's go back over. We're talking about references. Okay, the logical, once you get into this was the high on the big break to the downside. The market's taken almost all of that day back. The logical target right now is the high for this day. I don't know if it makes it or not, but and if you get to this high, that's another sign of change because it took all of this back. Once you get back into this range, once you look above this 2-day high, once you get back into this range, you've got to be thinking the potential is up to this trading range high. Again, that's your destination. I don't know if it makes that or not, but it's certainly something you have to be considered. You entered this from below, you've come back into it. Now the potential is to trade all the way back to the high. Whether it makes it or not, I don't know. You take it one step at a time. One of those steps is going to be you have a poor high right there. Okay, you've taken that poor high. So, you've gone back and revisited that high. You've taken that. The next upside target would be right up around the 2379 level. Okay, final question, please. And I'm not, if you got something that's urgent, I don't have to go. We've gone a long time.
Okay. Just quickly, I know you've just signed up for the mastery courses, so I want to just help him clarify. Sometimes, why do you have a reference line at 70? Sometimes Jim draws references as he's in a current discussion, but it's not relevant. So I don't want to cause any confusion with him. 70. Why do you have a reference at 70?
I have no idea. I don't know.
Yeah.
I didn't know.
Sorry about that. Sometimes that will happen, but thank you for asking.
The reference, if I were putting reference lines in here, they should be right here, which would be 2368.50. They would be right there at that poor high.
Well, that poor high was cleaned up, though.
No, I guess it wasn't. I thought it was initially. We haven't traded up there.
Well, but the day after, we opened above it and came back through it.
Thank you. Thank you. You're absolutely right. It was repaired. So the next reference line would be right up here.
Okay. By the way, I meant to say this. Peter Resnicek is hosting Jim today at 4:30 Eastern for a swing trading session. And I looked at the slides. We created them. It looks pretty cool. So if you want to be in on that webinar, you can see it at jdaltontrading.com, upcoming webinars, or you can go to Peter's site, shadowtrader.net. Okay, so just to give you the heads up there. Now a question about Peter. Peter Resnicek uses volume profile primarily. Could you please discuss your attitude why you prefer not to use volume profile in the conventional TPO construction for determining value area and volume POC?
Okay, I just commented on that about 4 or 5 minutes ago.
He asked this 7 minutes ago, so maybe it's prior, but if you still want an answer.
Yeah, let me come back at it again.
It's an important thing because a lot of people, get.
It comes up quite often. my feeling is that people get enamored with the volume profile and the volume POC because it gives them an exact number. All you have to do is take a fast look and you can see where the highest price is. And I think that gives you a false sense of comfort. And that volume POC can change pretty quickly. I don't use it. Julia stated it perfectly some time back. Too many traders want to go to war on using the volume POC or the more traditional POC that I employ. It's not worth going to war. Now, so one, I believe a lot of people like the value of the volume POC because it's an absolute number. It makes them feel more secure. The volume POC could occur at any price level. It does not incorporate time. Price advertises opportunity. Time regulates all opportunities. And volume measures the success or failure of the advertised opportunities. By incorporating time, so when I get a point of control or a POC, I am looking at both time and volume. When I have tested this multiple times over the years, because I know things change, and I have found by establishing the value area from using my traditional POC, it works just fine. But every few years, I take a look to see if anything significant changed, and the answer is no. But there's this big thing towards a volume POC because it's easy to read. People can tell you, boy, I got this, and I'm sorry, I just don't have the same confidence in it. But as Julia said, it's not worth going to war over. As I say on anything, if you're going to have confidence to trade, you look at something on your own, you make a decision. Anything I tell you, anything anybody else tells you, I want to teach you how to look at the market, what to look at. You then decide if you believe. I'm not perfect. Somebody said this morning, they don't think the market, that crude oil had anything to do with the market going up this morning. I don't know if I'm right. I don't know if they're right. Okay? And those are decisions that you make. Those are decisions. None of us have all of the information. Any of us have all of the information, we certainly wouldn't share it with you. If we had the exact information, it'd be worth so much. And when I look at markets, I'm just trying to have some idea. How do you help you learn how to think about market, how to think about price, how to think about time, how to think about value, how to think about references. And if I can help you learn how to think about markets, I think you've got a much better chance to become a successful trader. All right. Thank you very much. As Julia said, we will be doing the webinar with Peter tonight, and I will be addressing swing trades and give you just a little preview into that. And that is that I think the idea of a swing trade itself is much more of a romantic idea than it is an actuality. Everybody's, I get all the time, I get people call and say, well, I'm really not interested in your day trading. I'm a swing trader. Well, swing trading means something different to every single person. To one person, this is a swing trade from here down to here, from here back up to here, from here down to here. Okay, to another person, this is a swing trade from here to here, back up to here. Again, it is, I think it's a romanticized idea. It sounds nice, but we're going to look in that tonight. We're going to talk about that more seriously. And one more time, it's all going to come down to being able to, once you're engaged in a trade, being able to know how to monitor that trade for continuation. Anyhow, I hope I get a chance to share information with you tonight. Once again, thank you very much and have a good trading. In just a few minutes, we'll get some more news to add some volatility to this market. Thank you very, very much.
Thank you, Jim, very much. Everyone, I think, Peter, we don't have the webinar, so I have no, control over it. But Peter will certainly, I believe, record that webinar, so no worries there. And also, Jim, while we're looking at your chart, there's a question, and I know I'm just, I do this, but they're asking about the 6-wide POC. If you could make that a little larger just for this question. Do you see anything of value? And what I'm looking at with 15 minutes to go in the period, the POC is migrating higher. The gold BDEF letters was where the POC was at that time. Now in G, it's bumped up to where it is now. And if you think about it, depending where the auction goes, J period could print 7 wide, and that would bring the POC up higher. But do you have any comment for people? A couple of questions about the POC, its significance here at 6 wide, or the migration of it. Do you have any comment as the day goes?
Well, first of all, I come in and say we don't have a good high. We have a poor high because the I period came within 1 tick of the B period high. So at this point in time, we do have no excess. So we have a poor high. Okay. So the chances of that being taken out before the day's over are decent. Okay. Next, the POC, as Julie said, is migrated higher once. And one of the things you're always trying to do as a trader, you want to be able to visualize what it would take to change this profile. So what would it take? And Julia mentioned it perfectly. That it's 6 wide there, but it's also 6 wide, 1, 2, at all of these prices. 1, 2, 3, 4, 5. There's 7 prices. So if we print higher in J period, which comes along in 13 minutes, but we don't print back down to G period, now the point of control has migrated higher one more time. If we print in here in J period, but then we come down and print in G, now the point of control hasn't changed, and the market's getting more top heavy. So again, this visualization of what would it take to change that is very important. But right now, it has migrated higher, and we do not have a good high on this. It's a poor high because there's no selling tail at the top. All right. Thank you again. And pardon?
No, I said great. Thank you.
All right. Talk to you guys later. Bye. Thanks.
All right. Thanks, Jim. Thank you, everyone. Great questions. Great participation. We appreciate it. Always improves the presentation. So thanks a lot for hanging in. We'll have this recording up in about an hour. Don't forget to check out our upcoming webinars, or go to Peter's site, shadowtrader.net, and sign on for the swing trading webinar at 4:30 p.m. Eastern. Okay, everyone, thank you very much for being here. Have a great day wherever you're at, and we will see you for Kickstart webinar number 5 next week, and that will be announced this weekend in the report email with the password in there. Okay, so take care, everyone. Goodbye.